In the alternate version of exercise 8-4, we're presented with some information about a manufacturing machine that Ramirez Company uses within its operations, and we're asked to calculate the machine's second-year depreciation, specifically using the straight line method of depreciation. Recall from the chapter, depreciation simply is just a way of allocating the cost of plant assets among the periods that it benefits. It's just a way of trying to match that expense of using that item against the revenues that it helps earn. Straight line is one of the more common methods used. So let's start to look through the calculation for straight line. The overall formula is cost minus salvage value, which you recall that's going to be total depreciable cost, cost minus salvage value divided by the estimated useful life, and specifically the estimated useful life for straight line is a number of years. So we start to work through our scenario. The cost of the asset to Ramirez Company was $85,600 and the salvage value was $12,100. So we'll take $85,600 in cost minus $12,100 in salvage value. And if you recall that salvage value is just an estimate of what that item, what that piece of machinery would be worth at the end of its useful life. You know, what we expect it to be worth at the end of its life. Again, that's an estimate. The cost, we know for certainty. We can look through our records, but salvage value is an estimate. We're going to divide that by the estimated useful life. And that's something we're going to have to approximate how long that we think we're going to be able to use this in operations. And it indicates here that we're able to use it in operations for 10 years, so we'll divide it by 10. So if we take $85,600 in cost minus a salvage value of $12,100, we get a total depreciable cost of $73,500. That's the total amount of costs we want to allocate to expense over those 10 years. Divide that by 10, and we get an annual depreciation expense for each of the 10 years of $7,350 per year. Again, simply taking $73,500 divided by 10. The key to straight line is it's going to be the same amount of depreciation for each full year over the next 10 years. So if we start to build our scenario here, in year one, we're going to start with a beginning book value. And if you recall from the chapter, book value is simply cost minus accumulated depreciation. Well, at the beginning of year one, we haven't recorded any depreciation, so our beginning book value is just going to be the cost of $85,600. We start to move through here. The annual amount of depreciation expense that we're going to show in year one is going to be the same amount we'll show in each year, and that's going to be $7,350. So a journal entry would be a debit to depreciation expense for $7,350 and a credit to the contra asset account accumulated depreciation for the same $7,350. If we want to calculate the year end at the end of year one, what the book value is, we take our beginning book value of $85,600 minus our depreciation, our accumulated depreciation at this point is $7,350, and we get a year-end book value of $78,250. We want a depreciation expense for year two, so we had to do a little bit of work to get there. Again, beginning of year book value is going to be the prior year end of year book value, $78,250. Every single year, this is straight line. Every year we're going to record an additional annual depreciation of $7,350. So that's going to be our answer to our question is second year depreciation is $7,350 to get us down to a year-end book value of $78,250 minus $7,350 of book value of $70,900. I will point out that sometimes in these problems you'll be asked what's the depreciation expense. Sometimes you might be asked what's end of year book value. So just know how to calculate either one. Now I'm going to go through the rest of this rather rapidly, although not required, just to prove out that in every single year of the 10-year useful life, our annual depreciation expense is going to be $7,350. So every year debit depreciation expense for 7,350, every year credit accumulated depreciation for 7,350. And if we total these up, the total depreciation or over the life of the asset will eventually hit depreciation expense each year and reside in accumulated depreciation at the end of those 10 years is the depreciable cost of 73,500. Again, cost minus salvage value. That's what we want it to total up to be. Also, at the end of its useful life, in this situation 10 years, the book value is miraculously, this is what it's supposed to happen, going to equal the salvage value. We're going to bring down the book value on the books of cost minus accumulated depreciation down to the salvage value or estimate of what we think that item is going to be worth at the end of its life. Keep in mind their initial cost or book value was 85,600, but the end of useful life book value is going to be 12,100. So not too hard so far. I will also note that sometimes, again, you might be asked different questions. You might be asked what's depreciation expense for a certain year, what's book value at the end of a certain year. You might also be asked what's accumulated depreciation. So if I ask what accumulated depreciation was at the end of year 2 instead of annual depreciation or depreciation expense, that would include the combination of year 1 depreciation of 7,350 plus year 2 depreciation of 7,350 for total accumulated depreciation at the end of year 2 of 14,700. So be aware, depending upon what you're asked for the problem. I will also note that we made this problem fairly easy by acquiring the asset at the beginning of the year. It indicates right here. But not every problem you get is going to be beginning of the year acquisition. I mean, you don't think every single company buys all its assets on day one. They're going to buy them when they need them. In particular, what if Ramirez purchased this asset on March 3rd instead of January 1st? Well, we'd have to make an adjustment to the first year of depreciation because the reality is we didn't have that asset in use for all 12 months. If we purchased on March the 3rd, usually when something's purchased 15th or before, typically we round up to the beginning of the month. Just consider to make it a bit easier that we'll just round it to a whole month and consider it in use as of the beginning of the month. So what we do is take year 1 depreciation of 7,350, and being that we purchase on March 3rd and we round up to beginning of the month, we'll consider that we had that in operation for 10 of 12 months. So take 7,350 times 10, 12, and we're going to estimate that our year 1 depreciation, instead of being the full 7,350, would be 6,125 if it was purchased on March 3rd. Now, as we go through year 2, year 3, and on, it's still going to be the full 7,350, but being it wasn't an operation the full year at the beginning of the year, we would have to make an adjustment.